Stocks getting rocked. The S&P 500 on track for its worst week of the year, down 2% amid escalating trade tensions. Let's get to Bob Pisani at the New York Stock Exchange. Hey, Bob.
Hello, Melissa. You know, the markets have woken up to two facts. First, the odds of a tariff increase this Friday are much higher than the market expected. And secondly, stocks are dramatically overvalued if this happens. The market is still near historic highs because sentiment is positive around four factors. First, the Fed pivot. Second, a trade deal getting done. Third, China's stimulus program, and that is creating the perception for the moment that China's economy is bottoming. And finally, a strong U.S. economy. No trade deal with higher tariffs will force investors, though, to lower global GDP estimates. It'll force them to lower global earnings growth and force them to lower the earnings multiple associated with higher growth. That's a problem. Lower global growth drops the value of all companies. So you don't need to have revenue exposure to China or have import products from China to get hurt in this game. A lower multiple is a big problem. The market will assign a higher multiple to things if the global growth and earnings situation is expanding, but it'll assign a lower multiple if growth and earnings are contracting. Up until a few days ago, the S&P was trading at a 17 and above multiple. That is well above the historic average of 15 to 16 on hopes the economy was stabilizing. If there's no trade deal and higher tariffs on a broad array of products, global growth will clearly be lower and the markets will assign a lower multiple. But how much still isn't clear. If the S&P gets assigned a more reasonable multiple, say 15 and a half, that's roughly the historic average, the S&P could very quickly drop to the 2,600 range. And that is with no reductions in earnings estimates. It's a different game. Remember December when fears of a global meltdown dropped the S&P 500 multiple to 14 and a half. The S&P dropped all the way to 2350 because analysts were not only dropping the multiple, they were cutting earnings estimates at the same time. The bottom line is there is a lot more risk to the downside than there is to the upside right now. Back to you, Melissa.
All right, Bob, thanks. Bob Pisani at the NYSE. Tech getting hit hard by trade worries, down 3% this week. It is one of the worst performing sectors. The sharp drop comes after a big run this year for the tech heavy hitters like Apple, Microsoft, and Cisco. Our next guest says the group may have hit its peak. Let's go off the charts with Mark Newton of Newton Advisors. Mark, great to see you. What are you looking at?
Thank you, Melissa. So I want to take a look at technology. It's this year's top performing sector, up 24%. Yet in the last 2 weeks, we've lost over 2%. And so it's interesting when you look at things like the equal weighted technology ETF. This is by Invesco. I plot this over the S&P to get a feeling of how technology is moving as a group. You can see that just in the last week, we've broken this entire uptrend since December. So that's a little bit of a concern at this stage in the rally, suggesting that tech is starting to show signs of withering and that it's going to really be important to be a lot more selective in this sector. You see stocks like Google. This actually peaked right at the latter part of April. And a couple things to note here. One is that you have the potential formation of things like head and shoulders formations. A little early, you'd have to get down under 980. But in general, you see signs of big stocks like Google starting to show increasing signs of peaking out. You move down under 1250 in the last couple weeks. That broke, and it's going to have a tough road, I think, getting back. The momentum pressure starting to definitely lead lower in key stocks like Alphabet, Google. The third is that semiconductors, huge leading sector. What's this telling us? Similar to what's happened in technology, this has also shown evidence of peaking out. SMH getting down over the last couple days under these prior lows. This puts some definite pressure on semiconductors. My thinking is we're going to need to really get back up over this. It doesn't mean it can't happen, but near term, the sector is under a tremendous amount of pressure. It means that potentially one might want to take a look at areas like financials, healthcare. Definite rotation out of tech, and after being up 24% and in literally 4 months, it makes sense to consider, potentially shifting out of this sector.
When you say financials, Mark, I'm just curious because it seems like they had some lift at the beginning of the year and then sort of petered out in terms of that momentum. So which subsectors of financials are you looking at there?
Well, I continue to like really a lot of the big banks. We saw breakouts in stocks like Bank of America and Citigroup just in the last couple of weeks. And of course, with yields having turned down, there has been some downward pressure with the yield curve, and that has affected the group over the last week. But still, we've seen a decent amount of relative strength in this group, along with healthcare. It makes me think that really it's a sector to consider in the weeks and the months ahead. So Near term, look, S&P's been down 3 out of the last 4 days. My thinking is, maximum downside for S&P should be right near 2775, 2800. That should be a chance to get in, thinking that markets can push a little bit higher. But we need to see groups like technology participate. At least what these charts are showing us, that's not happening. We're seeing movement out of tech at 20% of the S&P. That could be a bigger deal.
All right, Mark, thank you. Mark Newton.
Thanks.
Pete, what do you think of this idea of peak technology?
Yeah, it's interesting because we've seen this rotation throughout this whole thing, and particularly now all of a sudden over the last couple of days as people have gotten more and more concerned about the whole trade wars thing, obviously you're seeing a rotation out of a lot of technology names. I think, quite honestly, we get an extension. If it's not anything that the market completely overreacts to, I think the technology names can still work. But with an overreaction, absolutely, we're going to see the tech names, I think, fall much faster than a lot of the other names right now because they're so tethered to the China market.
I'm sorry, go
ahead.
Go.
I was going to comment on Bob, who's talking about the multiple of the S&P, which, to me, people keep talking about how stocks should have a shrinking multiple. You have a contracting multiple when the Fed's hiking. We're not in a Fed cycle. In fact, equity multiples should be trading at 17, 18, 19 in an environment where I think people are concerned about the global growth story. So I would not be freaked out by an S&P that'll do 170 and be at 17 times.
You get peak tech, you get peak markets. Watch the 28.58 level in the S&P cash. That's your 50-day. We haven't been below it since mid-January. If tech peters out, the market peters out.